shine on the back of rising demand and shutdown of mines in China. Is this the right time to invest in base metals? The yellow metal is back in demand after US Federal Reserve hints at gradual rate hikes. Will gold continue to glitter in 2017? Crude oil seems to be back on a slippery slope as oversupply concerns persist. Will oil ever return to its glorious era? Sugar output debate sours. The government slams the Indian Sugar Mills Association for lowering output estimates. Do we really have enough stocks to prevent potential price rise? Commodity Champions starts right now.
Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta, and joining us on the show will be Keenan of Societe Generale and Peter McGuire of XM.com. Our discussion today is on the way ahead for commodities and which one should you have in your portfolio. But before that, let's do a quick roundup of the week that was for commodities. And starting first of all with the base metal prices, which have continued to shine on. The zinc prices have gained 7% this week, followed by rubber, which is also 4% up. The ferrous and the non-ferrous metals have put in a very strong performance, with steel prices and copper trading up by 3%. Aluminum as well gained up by 1%. And the glitter also shined in case of the precious metal space, where you had the gold and silver prices trading at one-week highs. Both the precious metals are up 2% in this week. Well, the factors impacting really have been the decline in dollar. The index is trading at a 4-week lows, and that has been supportive. The US Fed as well signaled gradual rate hikes in the rest of this year, and also increase in buying in global gold ETF has been supporting the prices on the higher side. It has been quite a volatile week, though, for the crude oil prices, where we did see some support on the back of speculative longs, decline in US dollar, and the US inventories as well declining after 9 weeks of surge. But then again, the US shale output is still on the higher side, and the global inventories remain at elevated levels as well. Markets, of course, were reading a lot into the spike in Saudi Arabia's Feb production. And, of course, apart from that, most of the banks have reiterated on how they are still bullish, still holding longs for the crude prices. Goldman Sachs, Morgan Stanley, Bank of America and Citi expect the prices to trade between 58 to 62.5 on the higher side in the second quarter of this year. A quick word on the currency as well, and the rupee is scaling new highs here. It's headed for its biggest weekly gain in last 1 year. It has been surging on the back of strong stock market rally, and you also have seen the prices actually appreciate on the back of weakness in US dollar. The other Asian currencies also have gained after the US Fed signaled gradual rate hikes. In other currencies apart from Asia, the euro markets gained after the incumbent Dutch PM won elections yet again. The pound, of course, would be in focus going forward from here as ahead of the French elections in the month of April. Well, the Fed's not so hawkish tone has led to the commodity markets gaining, but will they hold all of these levels on the higher side? This quarter, of course, has been much stronger, but will that magic continue to play up in the second week is something that we would want to watch out for. Joining us now is Keenan. Let's start with him first of all. Mark, hi. What is your sense? How has been the past quarter, and how have you read onto the Fed statements to start with?
Yes, that was largely in line with our expectation. I think the markets were a little concerned at the outset, but the statements have been comforting, and we've seen gold responding accordingly. And we remain on track. We expect, as the market does, 3 rate hikes this year, another 3 next year. All underway, really.
So what's your sense on the gold prices going forward, Mark? Because this is one area that has shown the maximum reaction. The last couple of rate hikes also actually led to buying in gold. Do you see that sustaining this time around as well?
Yeah, I mean, gold has taken some strength at the outset of this year on the back of all the forecast European elections and potential uncertainty over 2017 with the Dutch election that we've just had, and moving into the various other elections, German, Italian and so on, throughout the rest of the year. Well, what looks to be the case now is things, we don't forecast any massive problems. So our view on the gold price is lower, much lower for the rest of the year, in the context of the higher rate hike profile this year and next and the stronger dollar. So we see gold down to about $1,125 an ounce from where we are today. So about another $100 of weakness from current levels to Q4 of 2017.
Peter, getting you in the conversation as well, the quarter gone by has been quite eventful, volatile as well. How would you summarize and what do you take away from that?
You know, what we take on board so many different flavours over the last quarter. OPEC, oil, of course what's going on with precious metals, base metals and the grains and agriculture. But if I just primarily focus on first off energy, we've seen that solid uptick. The hedge funds were certainly moving to long positions and bullish positions over the matter of the last quarter, and that was very evident up until Houston last week, where that meeting was, everyone was probably thinking there's $55 to $58 chance of WTI and Brent, and then we saw a large price correction. So we're 2 and a bit months out from OPEC. I think on the May 25 it'll be a breakthrough style of meeting, quite simply because we'll be able to look back in the vision mirror and see whether those 5 months of cuts have been productive, what the landscape's looking like moving forward over the following 6 months, and some exciting times ahead. So yes, I think it's been quite an interesting quarter when you look at it holistically versus 2016.
All right. Mark, coming back to you, so what would you want to pick up? Do you see that coming quarter as well quite volatile, and where do you see the best pick in commodities now for the next quarter in sense of positional calls, in sense of investment as well?
Well, there's a lot of interesting things. I mean, first and foremost, you know, the commodity asset class as a whole is very fundamentally driven at the moment, which means that there's a lot of interesting opportunities, a lot of supply-demand driven opportunities. We are bullish oil, specifically after this dip as well. We're bullish industrial metals. Excuse me, both of them have a solid demand profile, muted supply outlook. So those are interesting. Specifically on the industrial metals, we're very positive towards copper from these levels, with a move up to 6,300 we expect by the end of the year, so about $450 a ton upside. Zinc, similarly. There's massive shortage in the concentrate market that's going to feed through into the refined market soon. So again, from these levels up to about 3,150 by the end of the year, so $400 there. And then oil, we see oil trending higher up to about $62.50 by Q4 on TI. And interestingly, also the structure of the market in terms of the forward curve, we see that moving into backwardation in Q3 of this year. So from a relative value perspective, playing that spread out is also an interesting opportunity.
All right. Peter, would you agree with Mark, or do you have another commodity that you want to pick up for the next quarter as the best one?
You know, I'm looking at gold, and I think that we've seen we saw Janet Yellen's 25 basis point rise. 2 words that really came out I took on board were moderate and, of course, gradual. So we'll probably see 2 rate rises or 2 additional rate rises in 2017, one very much towards the end of the year, probably December. So I think that there's possible further upside as far as gold. There's the uncertainty as what's happening with the Eurozone, weakness across many of the mature markets, and we've got the gallop ahead as far as, you know, US. We've got great, you know, the stock market's been very strong, and of course what's going on, that wash across to India, of course. So all of those flavours, I think, have got the potential to push gold a little bit higher from here, and I'm certainly keeping an eye on it, up $25 in the matter of the last 36 hours. So further upside, I wouldn't be surprised, and certainly volatility will remain.
Mark, I want to come back to you and let's talk about crude oil prices then, and we still have strong bullish bets there. Everybody from Goldman Sachs to Morgan Stanley to Citi is still betting on the higher side. What is your own sense? What levels are you working with?
Yes, I think 62.5 is where we're seeing prices by Q4. There's a lot of bullish bets out there. There's been some enormous amount of talk and coverage about the size of the money manager or the hedge fund long position in WTI through much of the beginning of this year. That's still in place. It's come off a little bit with the sell-off last week, but interestingly in Brent that position has built a little bit. But the most important thing is that people seem very overly focused on the size of the position in terms of futures contracts or barrels of oil. If you convert it into dollars, the size is not at the same extreme that the lots or the barrel limit is. And many of these funds manage their exposure, as you know, via dollar limitations or VAR restrictions. So there's still potential dry powder or ammunition for these funds to put on more length. We're bullish, and there's people that are able to buy the market. The noise about records being reached is not really true in dollars, and so we're pretty optimistic on prices.
Peter, and would you voice that as well? What is your sense? Where do you see the crude prices now trading within for the rest of the year? Would you say we've done the bottom already?
You know, I think it's going to be a 45 to 55 handle for WTI. I know that's a fairly wide gap, but the price movement, if you get the hedgies and they really gallop into a trade, they can certainly assist in pushing it further forward or of course, retreat. And we've got the geopolitical concerns at the moment. There doesn't seem to be a large degree of, as far as global issues, pushing that forward. Mother Nature has been kind to us as far as rigs, but that can all change mid-year. Summer in the Northern Hemisphere, driving season, hurricanes in the Gulf, and of course, you could, that powder keg of what the Middle East can turn into at short notice. So they are all large components to take on board for price.
Mark, what is your sense, and which metal are you picking up? Would you prefer copper, zinc? Where do you see more money is going to continue to flow as we get into the new quarter as well?
Yes, we would, specifically in copper and zinc. I think the picture is perhaps a bit more confusing in nickel. There's a lot of issues that need to be worked through. We've had a very volatile ride this year already with the Indonesian and Philippine issues. But certainly copper with the strike, the Escondida strike in Chile still underway in its second month. Issues in Peru, issues in Indonesia as well. So there is supply concerns. And Chinese consumption, Chinese demand data surprising to the upside. So it's a solid backdrop for copper. Similarly with zinc. Lead to a certain extent, although it's much more vulnerable to sort of battery dynamics and inventory dynamics. So those two, we're very happy holding them, and we suggest buying those on dips.
All right, copper and zinc are your top picks in metal. And Peter, what is your top pick in metal here? Are you also betting on copper going forward?
You know, if I'll start that off with iron ore. You know, we've got around about 130 million tonnes sitting in warehouses on wharves in China. I think they're the largest storage since around about 2004. So there's ample supply there, ready to be naturally used. There is talk, many analysts are saying, is iron ore going to have a washout this year? We're going to see, you know, a price collapse. That's a little bit of an unknown, but if it does happen, it'll probably be, you know, over that next 3 to 4 month window. Now, what effect, and that's why, what effect could that have to the likes of copper, nickel, lead and zinc? If President Trump, and he's moving forward with that infrastructure agenda, he naturally needs to go down that pathway of rebuilding, and that will require vast amounts of base metals. And so,
well, you know, yes, Peter, your point is well taken, because China is going to buy and there is infra spending expected into US as well. But what is your favorite pick when it comes to this sector?
I think you'd probably have to keep an eye on copper. I mean, it's a wonderful barometer, and industrial demand, I don't think, is going to lag. And if you go down that pathway, as if President Trump, and really, like all politicians, I liken him to a Modi in so many ways. I mean, they are deliverers, they're builders, they make things happen. Deep within Donald Trump's DNA, he is a builder. So, you know, he's got cement in his veins. This guy's going to get things done, and I really feel that over the next probably 100 to 150 days, there'll be a large degree of packages that he'll go to the market with and say, right, this is what we're going to do, this is how we're going to do it, because any politician naturally has to worry about their next term, and he's not the sort of guy, I believe, to sit on his hands, which has been quite clearly demonstrated over the last matter of months.
All right, gentlemen, Peter as well as Mark, we'll let you go at that. So that's the view really coming in from our